Good afternoon, everyone, and welcome to today's webinar, Summer Investment Roadmap, Navigating the Markets with Strategic Insights and Proven Strategies. Today, Krista Kerr and Frank Settino will be providing a market update, taking into account the current conditions. And at the end of the presentation, we will save some time for your questions. So on that note, just as a quick reminder, there's a Q&A icon in your toolbar, and please feel free to click on this icon to type in your questions that may come up throughout the presentation. We will be accumulating them throughout and we'll answer all of them at the end with our panelists. So we look forward to your questions. A little bit about Kerr Financial. For those of you who haven't worked with us before, Kerr Financial Advisors is a discretionary portfolio manager with a fiduciary duty to act in the best interests of our clients. We follow a disciplined, focused, long-term investment objectives focus that yields benefits, including building and sustaining wealth. We believe in diversification across asset classes, geographies, sectors, and companies, and follow an approach of building multi-manager portfolios through selecting best-in-class investment managers with diverse yet complementary investment styles. Again, Krista is our speaker today. She's the CEO and is responsible for the overall management of leadership of Kerr Financial. She's highly accredited with multiple designations, including a CFA, and is a key member of the firm's investment committee. She also leads the multifamily office division, which is a division which provides integrated services to support our high net worth families with multi-generational wealth stewardship. Krista is a thought leader in the Canadian personal finance industry, and she's appeared frequently on television, radio, and newspapers, addressing various planning and investment topics. Frank is responsible for our Montreal Investment Management Group and is part of the senior management leadership team here at Kerr Financial. He also leads the investment committee. He started his career at Tal Investment Counsel over 20 years ago, and prior to Kerr, spent 15 years as an equity analyst, helping portfolio managers in securing selections as a vice president of Canadian equities. Frank is also a CFA and a graduate of the John Molson School of Business. I'll now turn it over to Krista Kerr, who'll be discussing the current market condition and what it means for your investment portfolio today.
Thank you, Kathleen. Hello, everybody. As our usual practice with these webinars, we've sort of been following a similar format. So we're going to start with a little bit of a review of what happened during the quarter, the last quarter that we all experienced. What was the economic backdrop for that quarter, and also our outlook going forward, and then following on with what are our portfolio positioning comments. So we'll be doing that, and then Frank will be talking about some specific topics that he'll introduce. As is our practice, we're going to start with a polling question. So if Kathleen can put that up, you'll see a question. I'm going to read out the comments because I think when we do an audio playback for people, it doesn't always show up. So we're saying, given what you've seen in the current market environment, which of the following factors will have the most significant influence on your portfolio returns or on markets for the balance of the year? So do you think it'll be a risk of recession, either a higher or lower risk? But sometimes people are saying if things are slowing down, will that give an additional risk of recession? Would that impact company profits and my portfolio? Will it be the ongoing geopolitical risks that we continue to see that are important activities happening around the world and that we need to pay attention to? Will it be the U.S. elections, which are certainly getting a lot of attention in the press, especially over the last weekend? But will that have an impact on the portfolio? Or will it be some of the more fundamental issues like the Fed's response with interest rates or the Bank of Canada's response with interest rates, and how interest rates changing will impact the returns in my portfolio? Or sort of in a corollary to that, will it be inflation trends, which I guess could impact both the pace of interest rate changes and also corporate profits, et cetera? So all of these may have some impact, but what do you think would be most important in your portfolio? So not a lot of people concerned about recession. I think that, that makes sense to me. We're seeing, so sorry, just for people who aren't seeing this, we've got a bit of a balanced response. with US elections, interest rates, and geopolitical risks being the highest items, and 0 votes under risk of recession or inflation. I think those make sense. I mean, I think we're seeing the economy soften, but not so far push into recession. And I think inflation really impacts interest rates. So that's sort of covered in the other answers. So some people wondering in the short term, will geopolitical risks or US election uncertainty create impacts in my portfolio? And also saying that they think interest rate trends and the Fed response, central bank response to those will have a lot of impact. So we'll be addressing these topics in the webinar, but always good to get your input. So the next slide, we talk a little bit about what happened in the quarter, and I think a lot of people are focusing on headlines that say markets are hitting continued highs, which you are seeing with some of the indices. But we wanted to point out that the second quarter, the period from April to the end of June, was a little bit mixed, both in terms of what happened throughout the period and also what happened in various asset classes and sectors in the market. So this is really looking at the time frame of the quarter, and it's actually looking at a diagram showing the US stock market. So for those of you who remember back to April when we did this webinar last time, we at that point were seeing some pretty stubborn inflation prints. Inflation looked like it was sticking around a lot more than people thought, and therefore people were worried that interest rate cuts were really going to be pushed off, whether they'd even start this year. So the market started off negative in April. Both Canadian and US stock markets were off and bonds were off. So April was a difficult period. But if you were a patient investor and hung in there, you saw recovery in May and June. And that was really, again, seeing progress on inflation. So in May, the US CPI print came out at 0.16% for the month, which is on track to a 2% target rate. So that gave people confidence again that we were still seeing some slowing in that inflation and what we would want to see with a soft landing. That gave people more risk appetite. And then that, coupled with the support of people's believing in the AI theme and this potential extension of secular growth in that way, led to a positive. And then when you look at the various contributors to returns in your portfolio, it was also quite mixed. So on the left-hand side here, we have the things that did very well in that period. And you can see that, particularly it was US equity and emerging market equity. So US equity, if we look in Canadian dollar terms, was up 5.4%. Emerging markets equity up 6.3% in Canadian dollar terms. On the US side, it was really a narrow participation, so strong leadership from those mega cap technology and communication stocks, the Magnificent Seven type of stocks. You'll see that when we focus a little bit later on where the returns came from in terms of sectors. And emerging markets was a little bit similar. So there was very strong returns in Taiwan, which is really, again, investors' appetite for AI and chips, semiconductors. And then India, we had a little bit of valuation expansion as people were watching what was happening with Modi and the elections. That may shift a little bit, but that was quite positive in the quarter. And in China, there was slightly better than benchmark returns, and that was based on some of the government announcements that, incentives they were putting in place to continue to support the property sector and also stimulate consumption. Now, there's some concerns from people about China going forward, especially with, if more tariffs get put in place from the US, et cetera, what that would do to their growth rate. But during the quarter, those were very positive. We also had narrowly positive returns from bonds. The FTSE Universe Bond Index was up 0.9%. And that was really, again, with the expectations that rates would start cutting and Bank of Canada actually making one rate cut in the month of June. So we had those things providing positive returns. On the other side, other developed markets outside of the US were fairly lackluster. We had the Canadian market basically flat, down about 0.5%. We had EFI, which is Europe, Asia, Far East, being just very slightly positive, 0.9%. But we saw value stocks, dividend growers, and small and mid-cap stocks all being slightly negative. So while it felt like the markets kept going up, a lot of it was in the US market with the technology names and the emerging markets, and a little bit from bonds. So that was sort of what we saw in the background. The next slide will show you just some of those returns. And you'll see on the far right, if I'm reversing my usual order, but you see on the far right that our balanced benchmark, which includes some bonds, some Canadian, some US, some international stock, that benchmark was up 1.1% in the quarter. So it was positive, but not as strong as the other equity markets. If you then start from the left, you see cash was still up a little bit, 1.3%, which is on pace with about a 5% per year rate. Now, those returns will start to come off a bit as rates come down, but it's been a slow and steady, nice return from cash in the portfolio. The bonds, as I'd mentioned, were up 0.9% with a little bit of returning optimism that rates would be cut. Canadian equity pretty flat, but having done well over the past year to date and the 1 year numbers. And then US equity showing that strength again, 5.4% in the quarter and very strong 1 year numbers. International equity, as I mentioned, up 0.9 and emerging markets up 0.63 or 6.3 rather, sorry, as we talked about. So again, generally a positive result overall in portfolios, but coming largely from the US and emerging markets. And then we will have our usual slides that focus on style and sectors, but I thought it was interesting. This is a Morningstar diagram, and they look at what styles are contributing in the quarter. And you could see in the first quarter and the year, we've seen generally positive contribution from different capitalization sizes and styles. But in the second quarter, it was really marked that value, that whole first column, was red, was not contributing to the portfolio. And the bottom two rows, small and mid cap stocks, were also not contributing and they were detractors. So really it was the large cap growth and blend stocks that did well in the second quarter. The next slide just looks at sectors. So similar to what we said before, the first two sectors, technology and communications, those are where you find those Magnificent Seven stocks. They were up 13.8% and 9.4% respectively. Otherwise, you had some positive returns in utilities, but you had a bunch of detractors, energy, financials, industrials, healthcare, materials, all detracting in the portfolio. And I think that gives you a couple of thoughts. Frank will be talking a bit later. I'm giving you a preview, but he'll be talking a bit about concentration and wondering how much you want to have in your portfolio in various sectors. I think there's still good reasons for those large companies to be doing well, and there's a role for them, but there's also probably room for other sectors to catch up. You can see in these. And then the next slide really looks at, again, style. Just as we'd said, it was really quality growth that led the quarter, up 5.8 and 6.4% respectively. And on the farther right, you see value being not very positive, high dividend stocks not doing very much, and small cap not doing very much. So again, a fairly concentrated return profile. So then if we look behind that and say, what's the economic backdrop and what was happening that gave people appetite for risk or not in that period? So through the quarter, through the period of April to June, we were still focusing on fairly strong numbers, especially from the US. So other global economies, Canada and others, were starting to slow, as you would expect with a higher rate backdrop that we've had for a period of time. The US economy has remained very resilient, probably more so than people thought. So in the quarter, we continued to see that positivity. We saw real growth trending around 3%. We saw unemployment rates being low, under 4% for the last 2 years. And we saw inflation moving in the right direction. We still saw a healthy consumer. And that's an area that everybody is watching now. There was some US retail numbers came out yesterday that actually show the consumer is still present and still fairly healthy. People have been watching to see if that will change. But we had that positive, and then we had some tailwinds, some positive influence from government spending, which looks like it's likely to continue regardless of the US election outcome going forward. And then corporate earnings have remained positive. So quite a positive backdrop from those sides. We are starting to see some signs of softening in the US market. And that again would be expected given the higher interest rates and be what the Federal Reserve needs to start reducing rates going forwards. So we've recently seen GDP growth slowing to just below 2% in the second quarter. We're seeing personal consumption come down. We saw the services index, which had been very elevated, drop a little bit as well. And we're seeing a bit of slowing in the US labor market. Now, all of that, we're seeing signs of softening and slowing, not a crash landing. And so that really is as you would expect. And there are still these positive elements that are underpinning the economy overall. So in inflation, we'll just look at that. Things are moving in the right direction. They have been, we've talked about that in prior quarters, but you can see here, just looking at overall CPI and core CPI, it really peaked at about over 9% in 2022 and is now settling in. This was May numbers, so it was down in the 3.3, 3.4% range. So not quite down to 2%, but certainly big progress towards that goal that we saw already in the quarter. And then looking at some of the areas that have been stickier. So the stickier ones have been wages, have been housing, have been food inflation. So some of those are starting to come down too. I pulled some of these off of the White House website. So I think they're trying to show progress in inflation, but it was interesting to look at the food inflation. Now this is obviously year over year. So you can see at its peak, groceries were up 13.5% over the prior year, which is a huge increase that people were really feeling in their pocketbooks. As of June, the increase over the prior June was only 1.1. So it didn't go negative and erase those big increases that people were feeling, but it came down significantly. So there is some progress on food inflation. And then over on the other slide here, this shows you your housing and services, excluding energy and housing. So the farthest bar, which is in June, you can see that green bar, which is services excluding energy and housing, came down quite a lot in the month of June. Housing and rental rates are also coming off. So again, showing some nice progress in that area. And the next slide shows us some Indeed wage information, and you can see that this is also showing that wage growth is slowing as well, which has been something that has been elevated. So all of those are really showing progress on the inflation side, and you can see that's allowing inflation expectations to move in the right direction. This is a slide from Goldman Sachs Investment Strategy Group, and they're showing that the expectations for inflation would be back into the 2 to 3% range going forward. So that's definitely seeing some response to the Federal Reserve actions of the past and moving inflation in the right direction. Because of that, we're seeing some different movement on interest rates. So while the US Federal Reserve was seeing that sticky inflation and was not ready to cut, and they sort of held firm through the quarter, we did start seeing some central banks cutting. We saw the Swiss National Bank actually cut twice in the quarter, 25 basis points, well, once in March and one in June. So one in each of the first and the second quarter. And then both the Bank of Canada and the European Central Bank cut 25 basis points in June. So those are the economies where we were seeing that orderly slow down in economic activity, inflation moving in the right direction. We've seen some cuts. But now that we're seeing that softening that we talked about, it's likely that the Federal Reserve will also start to cut rates. These are both, again, Goldman Investment Strategy Group outlook slides, but they on the exhibit, what they were calling Exhibit 9 in their slide deck, they're looking at 2 rate cuts happening in 2024 with the first in September, and expecting the year-end rate to be down, inching down towards 4%. RBC is expecting, as of last week, still to see another 3 25 basis point cuts in Canada, maybe seeing the rate come down to 4% by the end of the year. And you can see on the right-hand side, this sort of overlays the Goldman expectations with those blue diamond, which is really the consensus or medium outlook of the Monetary Committee, where they're looking at what they call the dot plot. So they're looking at sort of a 5% interest rate by the end of 2024, 4.1% by the end of 2025, and then about 3.1% by 2026. So starting to see those rate cuts, which will help to allow sort of growth going forward. So while we've talked about some positive things, so we've had the economy holding up pretty well, the consumer still being healthy, inflation moving in the right direction, interest rates starting to come off, which will support growth, and still some positive tailwinds from corporate earnings and from fiscal spending. We don't want to get complacent. We know there are still a lot of risks that remain in the economy. So the consensus is that we have been achieving, or we have achieved, a soft landing across most economies. But that's still to be seen. I think Goldman Sachs is still talking about a 30% chance of recession. Their base case in any year is an unconditional lot of an 18% recession. So it's a little bit elevated, but much lower than it was in the past. So we still need to see what's going to happen with interest rates as companies refinance their debt, as individuals have to refinance debt, which in the US, they've got long dated mortgages, so they don't have to do it all right away. So we still need to keep an eye on that. And because there's still some potential there, we want to keep some defensiveness in our portfolios, and we'll talk about that in positioning. The other thing, as we noted in our polling questions, certainly a lot of serious caution and concerns around geopolitical events. You know, the war in Ukraine is still the biggest land war in Europe since World War II, and that continues to carry on and is a cause of concern for sure. The regional war in the Middle East is also important. A relationship between US and China, which continues to be strained, and other geopolitical risks. So we need to keep an eye on those. They can add volatility in the market. They can also impact returns depending on what happens. So we need to watch those. The US elections, which Frank will be talking more about as in his section, certainly adds some uncertainty. I think with both of those, with the geopolitical risks, they seem to be being contained and not escalating at this time, but that's the thing you want to watch there. And with the elections, with either party that could get in, there's probably not a huge difference in where you're going to be. I mean, probably your debt and deficits will stay elevated under either party or either a presidential candidate. So while there's uncertainty, there may not be major changes in outlook. Obviously, there are some changes on the election side in terms of regulation and tariffs, et cetera. And then the other thing is valuations are high. A lot of this good news that we were seeing before has been priced into markets. So that presents some downside risk. We just want to caution people that a pullback in the market of a 5 to 10% pullback is fairly normal for equity volatility. And you shouldn't be alarmed if that happens. That doesn't mean things are falling apart. It just means that there might be some volatility in prices. So because of these uncertainties, we want to maintain quality and diversification in our portfolios. So going forward, we still think there's a fairly constructive backdrop. That means we want to stay invested in our portfolios. We are seeing some softening in some of the economic data, and that should be supportive of central banks continuing this path to dropping rates. Those lower rates, along with fiscal spending, should continue to provide some driver for growth going forward, and corporate earnings outlooks continue to be positive. So that's all fairly constructive. But again, because of those risks, we want to keep an eye on those and be a little bit cautious in our outlook in portfolios. So looking at our positioning, even though we see interest rates coming off, we still think rates will be a little bit higher than in the past. So we're not making a big bet on moving into fixed income. We still favor equities over bonds, given all of the positioning that we have. If you know the way we manage, that doesn't mean we'd be absent an asset class. It just means we'll probably be at the lower end of our fixed income weightings and the higher end of our equity weightings, as we have been for a while. We really want to emphasize the importance of diversification, though. So again, it's important to have a little bit of bond exposure to manage equity volatility and to have breadth in the types of securities we have in the portfolio. We also want to emphasize quality because there still is that little bit of lingering concern about recession or what would happen to companies as they refinance debt. We want to make sure we've got invested in companies that have strong balance sheets and that don't have heavy debt loads and aren't looking at big debt maturities. Those would be ones that might be at risk. And then, as I said before, although we favor equities, we do think there's a role for some high quality bonds in the portfolio to both provide some returns, but also to be a ballast for equity volatility. And then while we've seen lots of strength in those Magnificent Seven stocks, those large mega cap technology and communication stocks, and while those are really good companies with strong balance sheets, and you still want to have maybe a little bit of role in them, there's room for some of the other returns to catch up. And so having diversification both in geography and sector continues to make sense. So that's sort of our big picture outlook for portfolios. And then I'll pass things over to Frank to talk about some specific areas that he wants to address.
Thanks, Krista, and thank you, Frank, for joining us. That was terrific. I think we're going to begin, just as we bring in Frank, with another polling question that you should be seeing on your screen. And I'm going to launch it here for you. And I'll just read it because I know some of our viewers might not be able to see it on the recording. So given that the US elections are this year, how do you expect this will impact market performance? 1, no significant impact on investment returns. 2, increased volatility leading up to the election day. 3, it might impact on specific sectors like oil and gas, depending on the election outcome. And 4, short-term market uncertainty with potential policy changes post the election. So I'll just give you a little time for some of you to vote before I'll show the results from our polling. Alrighty, I'm going to end the poll. Oh, anybody else? Get your results in there. Okay, I'm ending the poll and I'll just share the results here. And I'll read them out just, and then Frank can comment on it. So it looks like number 4, short-term market uncertainty with potential policy changes post-election, that got 55% of our viewers' votes. Then the third, number 3, impact on specific sectors like oil and gas, depending on the election outcome, got 25% of the votes. And then 2, increased volatility leading up to election day with 15%. And number 1, no significant impact on investment returns. Well, I think Frank might have something to say about this.
Yeah, I'll probably go into the finer details, but I am surprised by the fact that very few of the respondents thought that there would be no impact on investment returns. But we'll dig into that later on in my comments. But I have 2 topics that I want to highlight in today's webinar. I think both of them are very relevant in the current environment, and we hope we can shed some light in terms of how it impacts your portfolios. The first topic attempts to address the rising concentration we've seen in U.S. equity markets over the last year. We'll touch on a very interesting research paper that Michael Mauboussin from Morgan Stanley published last month that provides perspective on a topic that I think is generating a lot of attention as of late. And our second topic, we'll look at U.S. election and the impact it has on financial markets. The upcoming election this fall is certain to raise a lot of questions about various government policies and the impact it will have on investors. So we'll move to our next slide, which highlights research from one of my personal favorite observers in a paper titled "How Much is Too Much?" Stock market concentration measures how much of a overall market capitalization is in a small number of stocks. And in the last decade, we've seen the concentration levels in the US double. So the top 10 stocks represented 14% of the S&P 500 in 2013. It stood at 27% in 2023 and is now currently at 36%. So the rise is really a function of a few large companies playing an extraordinary role in the total market return. So for example, in 2023, half of the S&P 500 gain was attributed to the Magnificent Seven. The rise in concentration is raising a lot of questions for investors, including, can investors generate returns that can outpace a benchmark like the S&P 500 that is being influenced by so few stocks? And is there sufficient diversification in the market index? And I think there's also a simmering amount of speculation about whether the stock market is in a bubble. Mobison's paper attempts to provide a historical overview of market concentration levels in the US, but also provides perspective on market concentration in global markets as well. This chart looks at US stock market concentration over the last 75 years. And regardless of whether you're measuring concentration by looking at the largest stock or the 10 largest stocks, current concentration levels are at or at the highest levels in over 7 decades. And this dynamic extends into global markets as well, given that the US is such a large part of global equity markets. For example, in the MSCI All World Index, that includes mid and large cap stocks in 23 developed and 24 emerging economies, the top 10 stocks were less than 10% of the index in 2013, and currently it stands at 22%, with 9 of the 10 largest stocks being based in the US. The authors tried to address the question of what might be the right level of concentration. And to answer this question, the paper looks at concentration levels in a dozen of the largest markets in the world. As this chart shows, the US is the 4th most diversified market, and there are many countries in Europe, such as Switzerland and France, for example, where a handful of stocks make up a large part of the overall domestic market. In fact, a study of 47 equity markets found that the average weighting of the top 10 stocks was 48% between 1989 and 2011. Evidence suggesting that perhaps concentration levels in the US have been too low in the past. The general conclusion is that it's quite difficult to determine whether there is a correct level of concentration. I think the most interesting topic in the paper, however, was how the authors attempted to reconcile whether the massive growth in market valuations in the 10 largest stocks has been supported by growth in economic profit. So basically, is this increase in value in the largest companies justified by fundamental factors tied to profitability? This chart shows the economic profit of the top 10 large companies and the rest of the universe. So for example, in 2023, $481 billion in economic profit was generated in aggregate by US companies, of which $331 billion, or 69% of the total, was attributed to the 10 largest companies. So the 10 largest companies represent 27% of the market and generated more than half of the return for the S&P 500 last year. However, they also created a disproportionate amount of economic profits. In the last decade alone, the 10 largest stocks represented 19% of the total market capitalization, and they've averaged 47% of the economic profit. This is very much in line with historical levels. Therefore, there's a strong argument to be made that there's fundamental support that has led to an increase in market values in the likes of the largest companies. The next slide highlights the impact that the rising concentration has had for active managers. It compares the annual relative performance of small to large capitalization stocks to the percentage of mutual funds that outperform their benchmark. What the chart shows is that when large capitalization stocks do well relative to small caps, the percentage of managers that outperform the benchmark tends to go down. And the opposite is true when small caps outperform large caps. The red dot is 2023, when small caps underperformed by 10%, and a little over than 20% of mutual funds generate returns that outperform the overall market. Historically, in an environment where large companies outpace their smaller peers, it's been a very challenging environment for active managers to deliver excess returns relative to their benchmarks. The following slide explores market returns when market concentration is both rising and falling. Market returns tend to be above historical levels in periods where concentration is rising and below the average when concentration is falling. The S&P 500 compound annual return over the full period was 11.4%, but only 3.6% when concentration fell from 2000 to 2014, but a healthy 12% over the last decade. The next chart is interesting as the authors attempt to gauge what returns the top 3 stocks have generated relative to the S&P 500. The findings go back to 1950 and conclude that historically, the top stock has been a bad investment. The largest stock has underperformed the S&P 500 by 4.3% per annum from 1950 to 2023. However, the second and the third largest stocks fared better, but the degree of outperformance of 0.8% for the second largest stock and 0.3% for the third largest stocks weren't very significant. Having stated this, in the last decade, the top 3 stocks have materially outperformed the S&P 500. It's ranged from a 5.3 excess return for the third largest stock to a 14.2% excess return for the largest stock. Though the paper does not deliver a definitive conclusion of how much is too much, it does raise valid points on how challenging it will be for active managers with diversified portfolios to outperform the overall market if concentration continues to rise. We would agree that in many ways, the growth in valuation in the last decade was justified by the increase in economic profits. That could not be said in reference to the rise in concentration during the early 2000s when we had a handful of technology companies dominate the market. This final chart highlights the valuation disparity between the top 10 stocks and the S&P 500. Since 1996, the 10 largest stocks have traded at a P multiple of 20 times, or a 23% premium to the overall market. Currently, that premium is closer to 44%. So though valuation is a poor indicator in the short term, it's a far more effective tool of long-term returns. As such, we definitely want exposure to the top 10 stocks in our portfolios, but for diversification and valuation reason, we're also more focused on ensuring portfolios have exposure to the remaining stocks in the US market as well. Now, let's move to our second topic that explores US political elections and its influence on financial markets. We recognize that whenever there's a heightened degree of uncertainty about the future, whether that be company's growth rate or the next move for a central bank, we do see at times an increase in market volatility. We would argue that US elections are important events, and a change in leadership results in different policies that will impact markets. It can range from a change in trade policies and the associated tariffs, or a change in corporate tax rate, or more restrictive or more lax regulation. US elections generate a great deal of attention from the media at every election cycle. There's no shortage of strategists on various media platforms willingly providing their take on what impact the candidate will have on the economy and markets if voted into office. We were curious to observe whether historically financial markets did experience an increase in volatility due to uncertainty tied to US elections, and whether investors have been well served by taking cues from potential impacts from US elections in making investment decisions. A common observation in financial markets is that uncertainty triggers volatility. Asset prices become volatile when investors are forced to discount drastically different outcomes. The CBOE Volatility Index, or the VIX, as it's commonly known, measures the expected volatility of the stock market. The VIX measures the implied volatility of the S&P 500 over the coming 30 days. And over the last 30 years, the VIX has averaged at a level of about 19. We analyzed the VIX over the last 8 elections to see whether volatility levels rose in the final 3 months of the election campaign. We made 3 observations. First, we noted that the VIX was below the 19 level in 5 of the 8 elections, so market volatility was below historical levels. Second, in 6 out of the 8 elections, volatility levels actually diminished in the final 3 months of the campaigns. And lastly, in the 3 elections where volatility was well above historical averages, the economy was in the midst of a turbulent period. In 2000, the dot-com speculative bubble had burst, and many companies were struggling. The economy was growing progressively weak, and the prospect of a weakening economy was most likely the key catalyst for the spike in volatility. 2008 was the great financial crisis. Again, the massive spike in volatility, I think, had less to do with the election and more to do with the havoc that was being created by the unwinding of risky mortgages sold by Wall Street investment banks. And in 2000, we were in the middle of a pandemic. The economy was absorbing the impact of rising unemployment and uncertainty of how and when we would all return to our daily routines. The election certainly added to market volatility, but certainly it was not a normal situation for investors. And we would argue that the health of the overall economy was the key consideration. In the next slide, we tried to gauge whether US equity markets actually saw an uptick in volatility. Over the last 4 decades, 50% of the days saw a daily price return of the S&P 500 fall between positive and negative 0.5%. We analyzed market returns 3 months prior to election day for the last 10 elections. We observed how many days the S&P 500 return was greater than 0.5% or less than 0.5%, implying market moves above historical averages. In 7 of the last 10 elections, the daily price moves in the S&P 500 were below the historical average in the last 3 months prior to election day, suggesting muted price action in the US equity market. Again, like our previous observation of implied volatility, there were 3 election cycles where price moves in the S&P were above historical levels. 2000, 2008, and 2020 were periods in which we would argue that presidential elections were not the primary factor causing markets uncertainty and the large shift in equity markets. Our next slide looks at how markets performed 6 months after election day to understand how markets have reacted when a president has been reelected or the incumbent has taken office. The blue bars are when a political party retained power, and the red bars are when the incumbent party won the election. In 8 of the last 10 elections, the S&P was ahead nicely 6 months following an election, with returns ranging from 6% following President Reagan's re-election 40 years ago to the 13.4% return following President Biden's re-election win most recently. The 2 instances where the S&P was in a severe drawdown were in 2000, when President Bush was first elected, and again, this occurred during a contracting economy and widespread weakness in the technology sector. In 2008, globally, I think we were all in a chaotic environment tied to the great financial crisis, and the market weakness was not attributed to the election of President Obama. Therefore, though elections are impactful events, historically, any uncertainty on the results have not created a material increase in market volatility. Financial markets are complex systems, and a variety of different factors drive markets every day. Investors should not be overly focused on allowing the potential outcome of elections influence their investment decisions. I bring this up because I recall a conversation I had with a prospective client many years ago who was delaying investing a sum of money because they were waiting to see what the election results would be. What they failed to fully appreciate is that regardless of who's elected, over time, economies grow, markets evolve, companies innovate, and if one has a long time horizon, there's a greater benefit in being invested in a diversified portfolio. Our last chart tackles the wave of narratives that the financial industry will generate to attract viewership and trigger market action. Be aware that narratives don't always lead to strong investment returns. For example, the role of the energy industry has been a divisive issue during the last 2 presidential terms. President Trump was a pro-fossil fuels and supportive of traditional sources of energy, whereas President Biden has been more focused on supporting clean energy initiatives and renewable energy. Again, I recall many market pundits arguing that traditional coal and oil and gas companies were all positioned to reap major benefits when President Trump's policies prior to the election win in 2016, and that clean energy companies would be poised to struggle. The opposite happened during the 2020 campaign when pundits were suggesting that a Biden presidency would create major tailwinds for renewable energy producers. Anyone who acted on those narratives has been severely disappointed. During President Trump's term, the U.S. oil and gas sector fell 55%, while clean energy index rose nearly 3-fold. while the same clean energy index has slumped 25% during President Biden's term, while the oil and gas sector has reaped massive gains. Therefore, as investors, we should be cautious in making financial decisions based solely on simple narratives tied to a sector, a theme, or a geography that in many circumstances is a fairly complex situation. We're certain to see another interesting election campaign, and I'm certain that there's going to be a number of divisive issues grabbing headlines. Investors should remain focused on what they can control and position their investment portfolios to meet their long-term objectives. We hope the topics helped shed some light on considerations for your portfolios, and I will now pass it back to Kathleen for questions.